Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Saturday, November 8th, 2025, and we're here to break down the market buzz from yesterday, November 7th. Our AI-powered analysis has been busy, flagging quite a few stocks across various social media platforms.
That's right. While our systems processed a significant number of posts and flagged many different stocks, the discussions for a couple of them were particularly intense, showing a mix of high-risk speculation and fundamental concerns. It definitely feels like a day where caution is key, but there's also some interesting potential bubbling up.
Absolutely. Let's jump right into our first pick, Gap Inc., ticker symbol GAP. Brooke, I'm seeing a lot of excitement surrounding this one. Users are talking about some serious YOLO investments, with one person reportedly increasing their position to $48,000, anticipating gains of 20 to 100% in the short term. Plus, there's news about store modernizations and a new music-focused holiday campaign. It sounds like some forward-looking initiatives that could really turn things around, especially with the current price being notably below its 52-week high.
Well, Ethan, that's certainly a strong dose of community optimism. But when I look at the key performance indicators, my risk alarms are ringing. We're talking about a debt-to-equity ratio of 162.89. That's incredibly high, signaling significant financial leverage and, frankly, a lot of underlying risk for the company. And while the PE ratio looks low at 10.11, it's paired with revenue growth that's practically flat at 0.001. A low PE in that context often suggests the market perceives fundamental struggles rather than an undervaluation opportunity. Our AI's previous ratings for Gap have ranged from stay away to speculative gamble for these very reasons.
I hear you on the debt, Brooke, but these modernization efforts and the holiday campaign could be precisely what Gap needs to reignite revenue growth, you know? If those user predictions of a short-term pop materialize, it could really shift the market's perception.
It could, Ethan, but the KPIs reflect past performance, and for these positive developments to meaningfully impact the company's rating, they'd need to translate into sustained increases in revenue and, critically, a reduction in that substantial debt. Based purely on the current financial metrics, GAP is a stay away for most investors, particularly those seeking stable fundamental investments despite the passionate community optimism.
All right, let's move on to Archer Aviation, ACHR. Now, this is a company that truly screams future. We're talking about flying cars, the long-term vision for vertical transportation, potential military applications through a partnership with Anduril, and even an Olympic sponsorship. And get this, Cathie Wood's ARK Invest just pounced on sinking Archer Aviation shares with a substantial $26 million stake, buying the dip. That's serious institutional validation, and some Wall Street analysts are reportedly optimistic too. Sounds like a very exciting long-term play, wouldn't you say?
It's certainly exciting, Ethan, if you're comfortable with extreme speculation and a very long horizon. But let's ground ourselves in the numbers. Archer Aviation is essentially a pre-revenue company right now. We're seeing a net profit margin of 0 and earnings per share at negative 1.17. They're not generating revenue or profit, which means the stock's value is entirely speculative, based on future potential rather than any current financial performance. Plus, the debt-to-equity ratio is 4.85, which is quite high for a company not yet generating revenue, and the beta is a whopping 3.073, indicating extreme volatility. Our AI has consistently flagged ACHR as stay away in previous analyses.
But Brooke, you know Cathie Wood's firm isn't just throwing money around. They see a disruptive long-term vision and the potential for these partnerships to eventually deliver. Buying the dip after a share sale could prove to be a brilliant move if they execute on their ambitious plans and secure those regulatory approvals.
I agree that the news of institutional buying and strategic partnerships offer potential, which could drive confidence and eventually, hopefully, revenue. However, these are still future potentials. The current KPIs show a company far from profitability and operating with substantial debt. While the developments might eventually improve those metrics, they haven't yet. Therefore, while user discussions are indeed focused on future developments, the existing KPIs don't support an improvement improved fundamental rating for ACHR. For most investors seeking financial stability, Archer Aviation, ACHR, is a stay away, suitable only for highly speculative investors with a very high risk tolerance.
Investigate as buy. None. Investigate as cautious buy. None. Investigate as speculative gamble. GAP Inc., GAP. And that wraps up our daily hunt today.
Before we sign off, a quick but crucial note. This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you next time.